Hello and welcome to the latest Insider interview. I am here with Ariel Bezalel, manager of the Jupiter Strategic Bond Fund. Ariel, thank you for coming into the studio today.
Thank you.
So can you please tell us a little bit about the fund? Where do you invest? What's the yield in it? And what makes it strategic?
So the fund we launched in 2008, and it's a top-down, bottom-up approach to investing in the world of fixed income. So it really has this very dynamic, flexible approach in terms of where we invest geographically. So we've got positions across emerging markets as well as developed markets, where we're very active across Europe and America. And from a top-down perspective, on the back of very intensive macro work, we look to see where the optimal situations are, where we believe interest rates could be set to head down in future months or years. And that's based on big long-term macro views. A lot of our views, I would say, we look for them to pan out over 12 to 18 months. And then from a bottom-up perspective, I've got an extensive team of credit analysts. And what we do really is cherry pick the opportunities across investment grade, high yield, and even sometimes venturing out into distressed. And what we look for typically are what we call deleveraging credit stories, companies that over time will pay down debt through growing earnings or free cash flow.
And the yield on the fund, what does it yield at the moment? And is there a target for what you want to pay shareholders in terms of income?
Yeah, so we don't target a yield. We'll never put our clients' capital at risk to achieve a certain level of income. But today, the yield on the fund is the highest it's been for quite some time, at nearly 8%, in fact. And we'll talk. I've no doubt we'll touch a lot on this later, but we're seeing some really interesting opportunities across fixed income. The biggest opportunity set, in fact, for quite some time.
And why is it so important to invest across the fixed income spectrum rather than just focusing on, say, UK companies or government bonds? Why is there so many exciting things out there at the moment?
So with the flexibility we have, and sometimes there are, from time to time, like now, for example, volatility on the macro horizons. And so with the tools at our disposal, we can use the likes of credit derivatives. We can sometimes also use government bond futures to help manipulate the interest rate exposure to protect our clients to the downside. So using the use of derivatives, the flexibility allows us to carry our clients' capital really through the economic cycle and hopefully try to protect themselves from some of the pitfalls out there.
What is the typical split in the fund, and how are you positioned at the moment in terms of government bonds and corporate bonds?
So to keep it simple, when we're feeling pretty optimistic about the economic outlook, you'll find a higher allocation to corporate bonds. You'll find, and within that, we'll have a higher allocation to the likes of high yield, which tend to do well in a healthy economic environment, in a bullish economic environment. And when we're feeling a bit more cautious, a bit more pessimistic about the outlook, we'll tend to increase our government bond exposure. And to be more specific, it's to higher quality government bonds where we'll increase our exposure. So to the likes of UK government bonds, US treasuries, etc., where we'll increase our exposure. In terms of how we're set up today, we're set up pretty cautiously. So today we have over 50% of the portfolio in high quality and typically medium long dated government bonds. That's dominated by exposure to the likes of US treasuries and Australian government bonds. And then on the other side, in our credit book, although optically it sounds a lot, we've got about 50% of the portfolio in high yield. If you actually look under the bonnet within that high yield exposure, it's dominated by short-dated paper, defensive sectors such as telecoms, healthcare, pharmaceuticals, hospital operators. And then we've got within that a number of special situations where we're generating pretty high yields, and we see a catalyst for the bonds to perhaps be taken out at a premium in the near term, or we're waiting for some sort of event that could lead to a pop in the bond price. That's how we define some of the special situations we have in the portfolio today.
It's been a tough start to the year for the funds. It's fallen about 10%, and this has come as global markets, global stock markets have also fallen. Bonds are meant to be a defense against volatility, against pessimism in markets. So why has the portfolio fallen in tandem with stocks this year?
Yeah, that's a bit of a misnomer, you could say, in the sense that it depends which bonds you own in terms of how they protect you through certain economic environments. But typically, you're right. If we are in a slowing down growth picture, and inflation is pretty benign, typically government bonds would do pretty well. Corporate bonds may actually suffer in that environment, especially the likes of high yield bonds. But the reason the environment this year for bond investors has been very tricky is because we have a high inflation picture, and combined with that, a slowing down in global growth. So that's quite toxic, also commonly known as stagflation. Coming into this year, our view was that the inflation picture, the inflation outlook would start to improve, i.e. inflation numbers would start to come down Q2, Q3. And we felt that there were a number of signs that the economic picture would start to deteriorate, which would mean that central banks would have to start thinking about cutting rates in the not too distant future. We actually believe that's still likely to happen, but that the inflation, the rollover inflation just simply means it's going to be a bit further out. Now, the reason why the high rates of inflation have caught us offside a bit is because of the Russia-Ukraine war. The Russia-Ukraine war led to another sharp rise in commodity prices, led by the likes of food prices and oil prices and a whole host of other commodities, in fact. And but of late, what we are beginning to see is that a lot of these commodities are starting to come off quite sharply. So whether it's metals, the oil price is starting to crumble, and even agricultural commodities are also softening up. And we're also seeing a number of data points from the likes of America and especially from Europe telling us that growth is becoming more and more challenged. And so we think that at some point later this year, the Fed will have to rethink its hawkish bias, and that should trigger a decent rally in government bonds. So you could see a bit of a round trip and the reverse of what we've had year to date in government bonds, in our opinion.
And the fall in bond prices has meant higher yields. You can now get a decent income from bonds. Finally, you said the fund yield's about 8%. So it's now a great time to actually be investing in fixed income.
The way we think about it today is if you look at the overall high yield market and the overall investment grade market, it's not, broadly speaking, it's not necessarily pricing in a decent recession yet. However, if you cherry pick opportunities, and that's what's great about active asset management, that's what we can do, is cherry pick those opportunities across investment grade and high yield where we think a decent recession is being priced in, and where you have fairly defensive characteristics in a lot of the businesses we're lending money to. We think that there's pretty good money to be made on a kind of 12 to 18 month view. So for example, we're buying triple Bs in real estate companies, in certain healthcare businesses on spreads of 250 to as much as 400 plus over. I mean, that's recession-like valuations. And within high yield, in double Bs and high quality single Bs, where we're secured on assets such as telecom networks, cable networks, and even hospitals, and sometimes even gaming companies where we're secured on the business, which also has a bit of a defensive element to it. You can get high single digit, 6, 7, 8% type yields, the kind of yields we haven't seen in quite some time, in fact. But look, having said all that, what we're doing in the fund is realizing that the economic landscape is going to be somewhat challenging for at least the second half of this year, if not as we get into 2023. And so to protect and hedge our clients, that's a big factor as to why we've got a healthy allocation to high quality sovereigns as well.
Ariel, thank you very much for coming into the studio.
It's been a pleasure. Thank you.
And that's all we have time for today. You can check out more videos on our YouTube channel, where you can like, comment, and subscribe.